Well, it seems like this is a perfect opportunity then for all these people you've talked about in the past that have all this equity in their homes to say, hey, if I want to do some remodel, I want to add some solar, I need to replace things or whatever, this is a perfect opportunity because the money has gotten less expensive. Is that true?
That is exactly right. Yeah, and see that's and this is all correlated, right? Because you've got those folks with the 2 and 3% mortgages out there. Um, they're going to continue in this environment, given what's happened with long-term yields and long-term mortgage rates. They're going to continue to most likely not want to sell. They may, well, I should restate that. They may want to sell, but they feel like they don't want to sell because they don't want to trade a 2.5% mortgage for a 6.5% mortgage. So then they have to kind of calibrate their options and maybe decide that they're going to stay put and then take advantage of the growth and equity that they've achieved and then figure out what they can do where they're at currently rather than selling and buying something else because they just want to avoid that longer term rate.
This is a question I want to ask you because again, you've got over 4 decades in this industry. As far as this this situation where the Feds have lowered the interest rates for short term,
Mhm.
and we have a situation where typically when the rates are higher, what does that do to the home values in a normal market? Does that make them go up or stabilize in price typically?
Well, that's a really good question because the market we've been seeing for the last couple of years doesn't really necessarily track to normal, normal changes. In other words, normally when mortgage rates are creeping higher, and in this case they've gone up quite a bit, they've doubled from 2020 and 21, right? Now, normally basic econ would say, well, if rates go up a whole bunch, that's going to dampen demand for housing, which is going to cause the value of housing to drop. And that's frankly what we all expected. But unlike past cycles, this cycle is entirely different than anything I've seen in over 40 years, which is that housing stock that would have, in a normal circumstance, dropped in value as mortgage rates doubled from 2.5, well, more than doubled actually, from 2.5 to 6.5. And the reason that didn't occur is because too many people who own homes now have chosen to sit still, not sell, because they don't want to trade that 2 and 3% mortgage and go into something that's going to be 6, maybe 7, even if they have a lot of equity and they otherwise would like to sell, maybe get a bigger home, move to another location, what have you. They're locked in. They don't want to do that. So what's happened is this sort of odd combination of mortgage rates have gone way up in a relative sense, because I'll argue still mortgage rates, generally speaking, historically are not that bad.
Mhm.
But even though they've gone up a whole bunch, we haven't seen enough increase in inventory that normally would be triggered by elevated mortgage rates, because too many of those existing homeowners, that existing housing stock has such cheap money secured by it, they don't want to sell. So we've got
Mhm.
this lockup situation, low inventory, high rates. What has that done? Home values keep creeping up. Even this past year, they're up like over 4% annually, and it's expected they're going to go up at a slower rate in 25, but they're still expected to go up probably in the 2 to 3% range, maybe 4. So, and if we're still going to be looking at rates that most likely are going to be in the sixes all of next year, this kind of environment is likely going to continue for an extended period of time.